The FTSE 100 stands around 15% above its winter's low, but the UK's leading benchmark is making very slow progress, if any, toward the intraday all-time high of 71.23 that it reached in April 2015. Now, for a specific stock or indeed a broader index to go higher, you probably need two things on a sustainable basis. You need an attractive valuation and a catalyst or trigger that convinces your fellow investors now is a good time to buy and that value is going to come out. The reverse applies on the way down, of course. You need an overextended valuation and something that persuades investors to sell in the view stocks or indices are expensive. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our weekly markets review Breaking the Mould, I'm going to look at the FTSE 100 and FTSE All-Share indices to see if they could be cheap or expensive using historic metrics and what may trigger a major trend move in the UK's leading benchmark indices. So first up, let's look at where we are today, and a chart can be useful here. I must stress, I am a trained analyst, a fundamentals guy, not a technicals man, but even I can spot a bear market chart when I see one. It's characterised by a series of lower new highs and lower new lows. And this here is the FTSE 100 since January 2015. It's not that pretty from a technicals perspective, and so the FTSE 100 looking at that needs to hold above 60.84 and then sustainably move beyond 63.15 and 64.44 to give bulls something to shout about. Equally, a fall below 60.84 could be a worrying sign, even if, as we all know, the past is no guarantee for the future. Now on valuation, well, earnings forecasts tend to be unreliable. The forecasts are no good, they move around too much. Instead, therefore, I prefer to look at market cap to GDP and the dividend yield relative to the 10-year gilt yield when assessing long-term valuation. Market cap to GDP looks toppy at around 115%, assuming history is a fair guide. The dividend yield angle looks a bit more attractive, at least based on past trends, with a yield of 3.8% on the all-share and a 1.4% yield on the 10-year gilt. Stocks are yielding 240 basis points more, or 2.4%. Clearly there's greater capital risk, but a premium of near 2.5% helped call the bottom in 2009 and 2012, though note that premium got to 290 bips or 2.9% in February. Things can overshoot. Unlike market cap to GDP, though, that suggests UK equities may be cheapish. The snag being things will look less good if there are lots more dividend cuts or bond yields rise owing to an inflation scare or interest rate hike from the Bank of England. Now that takes me on to what could trigger this debate over whether stocks are cheap on yield, expensive on market cap to GDP, and its earnings. Yes, the FTSE 100 is around 14% below its all-time high, but it's no higher now than it was in January 2013 or October 2006. Why? Earnings. As legendary investor Ben Graham once said, in the short run, markets are a voting machine, in the long run, they're a weighing machine. In other words, fads, fashion, macro noise, trades and momentum jockeys will dominate the short term, but earnings and cash flow will have the ultimate say. Now, as you can see here, our research shows that the FTSE 100's current crop of members earned less in pre-tax profit between them in 2015 than they did in 2006. This helps to explain the final chart. It shows the compound annual growth rate over the 2016 to 2015 period for UK GDP, FTSE 100 pre-tax profit, FTSE 100 index capital returns, FTSE 100 index total returns, including divvies. At least, when someone seems to be saying we're stuck in a slow growth, low inflation, low interest rate world, we now know why, given the torpid rates of progress seen over the last 10 years. While we should never extrapolate from the past to the present too freely, if these trends do continue, then the importance of reliable income to investors may continue to grow, as total returns have at least outpaced capital ones over the past decade. Thank you for watching, and I look forward to seeing you next time.